Let me ask you something. You work hard for your money, right? But is your money working hard for you? Because right now, in 2026, just letting your cash sit around, that's a huge missed opportunity. So let's get into it. Let's figure out how to wake up that lazy money.
So let's just get right to it. Think about your savings account for a sec. Is it actually, doing anything? Is it growing your wealth? Or is it just kind of sitting there? If you're like millions of other people, the honest answer is probably a little bit uncomfortable. And yeah, here's that uncomfortable truth. The national average savings rate is, wait for it, 0.62%. I mean, that's practically nothing. It's barely moving the needle. It's like your money isn't just taking a nap. It's in a full-on coma. But what if it could be earning this instead? We're talking top high-yield savings accounts offering rates around 4.2%. That's what? Almost 7 times more than the average. That gap right there, that is the real cost of having lazy money.
Right, and this gets to a super important point. There's a hidden cost to keeping your savings in the wrong spot. It's not just that you're missing out on some extra cash, it's a real, actual financial loss that just gets bigger and bigger over time.
So, the big question is, why? Why do we do this to ourselves? Well, it turns out there's some really interesting human psychology going on. It's the hassle, right? The thought of switching direct deposits and all that, ugh. Or maybe we're just a little bit sketched out by banks that are only online. Some of us are just loyal to that branch on the corner we've used forever. But honestly, for most of us, it's just the power of doing nothing. It's just easier to leave it where it is.
Okay, but here's the secret to breaking that inertia. Once you understand how these online banks can pay so much more, it all starts to make sense. And it really just comes down to their business model.
Check this out. This is where it all clicks. Think about it. Your typical big bank has thousands of branches. That's a ton of money for rent, electricity, staff, just massive overhead. Online banks, they don't have that. They've swapped all that expensive real estate for sleek technology. And here's the kicker. All that money they're not spending on buildings, they can pass a huge chunk of it directly to you as a much, much higher interest rate. Simple as that.
So at the end of the day, it's a simple trade-off. Traditional banks, they're selling you convenience and in-person services, if you need a notary or a safe deposit box. Online banks, they're selling you a much better return on your cash. It really just comes down to what's more important to you for the money you have saved up.
Okay. I know what you're thinking. This all sounds great, but is my money safe in some bank I've never heard of that exists only on the internet? And look, that is probably the #1 question, and it is a totally fair one to ask.
So let me be absolutely clear. Yes, your savings are safe, and that's not just my opinion. It's a fundamental feature of how the entire U.S. banking system is built.
And here's the reason why, in 3 letters. FDIC. This is federal insurance. It protects your deposits, every penny of your original money, plus all the interest you've earned, up to $250,000. And it makes zero difference if that bank is a big marble building on Main Street or an app on your phone. If it's an FDIC-insured bank, your money is backed by the full faith and credit of the United States government, period.
All right, that all sounds good on paper, but what happens when the unthinkable happens? What does it actually look like when a bank fails, like for real?
Well, we don't have to guess. Let's look at a super recent case study. Republic First Bank, back in 2024. Here's what happened. On a Friday afternoon, regulators step in and close the bank. Total chaos, right? Nope. Over that one weekend, the FDIC steps in, arranges a sale to a totally healthy bank. And by Monday morning, the branch is literally reopened with a new name on the door, and every single depositor had seamless, continuous access to all of their insured cash. It worked. The system worked exactly like it was supposed to.
All right, so we've established 2 huge things. These accounts pay way more, and they are absolutely safe. So now let's level up a bit and get into some of the details that savvy savers really need to know. We're going to go beyond just that big, shiny APY number.
So here's a question for anyone lucky enough to have this problem. What if you have more than $250,000 to protect? Do you seriously have to open like a dozen different bank accounts? Well, the good news is you don't. This is where some really clever financial technology comes into play. A lot of companies now offer these things called sweep programs. It's pretty cool. You just make one deposit with them, and behind the scenes, their system automatically sweeps your money across a whole network of different partner banks, making sure no single bank holds more than that $250,000 limit. So you get one simple statement, but your FDIC coverage is multiplied, sometimes into the millions of dollars.
Okay, quick reality check, and this is important. All that awesome interest you're earning, yeah, Uncle Sam considers that income. So don't forget, You're going to get a tax form from your bank, and you'll have to pay taxes on those earnings, just like you do on your regular paycheck.
And last but definitely not least, we got to talk about security. Because in today's world, the scams are getting scary sophisticated. We're talking about AI that can clone a loved one's voice to fake an emergency, or automated bots that pretend to be your bank to steal your security codes. It's wild stuff. Seriously, just knowing that these tactics exist is your #1 best defense against them.
So, where does all this go from here? I mean, interest rates are never static, right? They're always moving. So let's zoom out and take a look at the big picture for 2026 and what might be coming next.
Man, this timeline really tells a story, doesn't it? It puts everything in perspective. Think about it. We've had these wild cycles. Rates soaring to a crazy 19% in the 80s to fight inflation, then crashing down to basically zero after the 2008 financial crisis. And then, bam, the most aggressive rate hikes we've seen in 40 years to battle that post-pandemic inflation surge. Which brings us to today, where we're now in what the experts are calling a strategic easing cycle.
So what the heck does strategic easing mean for your savings account? Well, this quote really nails it. The party might be over for those 5% plus risk-free returns we saw for a bit, but, and this is a big but, the forecast is for rates to settle around a still very attractive 3.7% by the end of 2026. And let's be real, that's still a fantastic return for your safe liquid cash.
And hey, here's one more pro tip, especially if you live in a high-tax state like California or New York. High-yield savings interest gets hit by federal, state, and local taxes, but interest from U.S. Treasury bills, or T-bills, is totally exempt from state and local taxes. So depending on your situation, a T-bill could actually put more money in your pocket after taxes, even if its starting interest rate looks a little lower.
You know, if you remember just one thing from all this, let it be this. That cost of doing nothing, of just leaving your money where it is, that's not just some abstract idea. It is a real, tangible financial loss. It's money you could have had but didn't, and that loss just gets bigger every single year.
So let's wrap this up. We've seen that much higher rates are out there for the taking. We've seen that these accounts are 100% safe, and honestly, switching is easier than you probably think. The cost of inertia is real. So the only question left to ask is, what are you going to do with your lazy money?